While SIPs are hailed as the ultimate wealth building tool, the reality on ground tells a very, very different story. Between beginner confusion, portfolio overlaps, high stoppage rates, and emotional panic over market slumps, many investors tend to lose their way before reaching their financial finish line. Today, we are breaking down the hard truths about SIP behavior and how you can stop sabotaging your own returns. Let's decode how to make SIPs work for you. So, hi, Sham.
Hi.
Sham, SIP investing is a very important topic. It seems very easy on the outside, especially for beginners. Now, just look up, do some research, and start one or two SIPs. It seems very, very simple. But a lot of people seem to be getting it wrong, especially the beginners, even at the start. So, what do you think is going wrong despite all the information available?
See, firstly, I don't think only beginners get their investment choices wrong. Anybody can get their investment choices wrong, including professionals like me and you. So, when you are making your professional choice, you must be careful to avoid those mistakes.
Okay.
Why do these mistakes happen? Generally, what I have seen is this research, quote unquote, what you call as research, is basically nibbling with past performance. People play around with past performance. Earlier, they used to just refer to some websites. Now they are using AI, which goes and nibbles with the website. AI doesn't have a mind of its own. It again goes to the same platforms where you would otherwise go and then does scanning and comes up with the same thing, more or less. So, the reason why decisions go wrong is because of overemphasis on past performance, and people make decisions when the past performance is at its peak, generally, and then after they make the decision to invest in a SIP where the past performance is at its prime, very best. Subsequently, once they start investing, the performance starts weakening, and that weakness keeps growing, and that reflects in the SIP book of theirs. So you looked at the past, which is disconnected with the present and the future, and you picked it exactly at the time when the disconnection is about to take full effect. This is why SIPs fail. It's simple. So I think the way in which the decisions are made, the choices are made by people, whether they do it through their own research on a website which gives past data and some minimal analysis, or they do it using AI, which in turn goes and layers its judgment on the same websites. These mistakes are bound to recur. It's been happening from the time I have seen mutual funds, which is from 1993. This mistake has been happening. The websites came a little later, but even then they used to go to the data sheet, fact sheets, look at past performance and then buy.
Okay.
Then from fact sheet it moved to mutual fund research platforms, and now it has further moved to AI, but they all stand on the weak legs of past performance.
Okay, okay. So, assuming that somebody gets it right, doesn't look at past performance, looks at the future, or takes the help of an advisor, whatever, it doesn't, doing it right doesn't stop there, isn't it? A lot of times, people want to add SIPs. We keep saying, step up your SIPs as your income increases and all. People want to add SIPs is number one, is one of the reasons. The other reason is also that at the end of 1 or 2 years, people get very jittery. They want to see if there is something which is
Better.
better for their portfolio. So, this process of review and replacing an existing fund or adding a new fund seems easier said than done. So, when does one actually review and when does actually one let go of a fund or add a new fund? And even if they are stepping up, whether they add to the same funds or add to a new fund, these are all very difficult questions in the process, isn't it?
See, actually, mutual fund portfolio investing is more sophisticated than equity portfolio
Yeah.
investing, because there is a layer you're adding, which is another manager, his judgment, his confidence in the market, in the economy. So it's actually more complex. We think it's easy. That's the first point. Uh, Judging another person who runs a product, you have to do two reviews of the person and the product.
Yeah.
I'm not going into the judgment on the entity which employs this person and produces
Okay,
this
that's a
product. That's the
third
third
layer.
level.
Yeah.
So I think people cut everything short to performance. I think it's very important to judge these three things. And when you do it correctly and objectively, you are comfortable to stay with one entity, one product, and one manager for a very long period. You will also stay with them, the entity, product, and manager, all three, when the product is not doing well. That's very important. See, I'll give you an honest opinion, or rather, I'm just sharing a part of my experience, frankly. The most money I made in mutual funds for my clients is when I picked a product which had very, very mediocre to bad past performance.
Okay.
That's the starting point. Now, everybody starts at the other end. The entire industry, everyone starts at the other end. Whereas for me, I start at a place where I can't lose much. I see a manager who is doing all the right things. He is doing it in a product which is constructed very well, and the product merits are strong. The way he has built the portfolio, the position sizing, the allocation, the liquidity he maintains, everything. And then it's backed by a manufacturer, which is a AMC mutual fund, who will allow him to do this for a very long period of time, even if the performance is not great. I'll give you a very good example. There was a time when the value philosophy, which an AMC had really built into a solid product, was not doing well.
Yeah.
Let's say it did very well for a decade, then 3, 4 years it was not doing well. We started backing the manager and the product and the AMC, all three. And we backed a product which had a smaller asset base because it's a more compact product. At that time, everyone was not agreeing because past performance was modest, soft. His portfolio was constructed very well. I said, this will win. Now, question is whether I'm going to wait 2 year, 3 year, 4 year, 5 year. I'm ready. Then two stocks doubled. Then everything else started going up. But I know what that manager faced from his ecosystem. I'll put it that way. Because every fund manager faces an entire ecosystem. I felt it was very, very wrong because I know the merit of the product as a manager myself and as an investor. Both both the hats are actually the same. But when I see it from that hat, I found that this guy has done a brilliant job. Most of the fund investing which I like to do comes from a very clear objective analysis of the portfolio, the product, and the manager and the manufacturer. Uh, most of the investing today that is happening only on one metric, that is past performance.
Okay, from what you're saying, it looks like, you will need an advisor to invest in mutual funds, but this is the age of direct plans. And if you see the AUMs also, the percentage of direct plans in total AUMs in the mutual fund industry is increasing steadily. So, would you say that then an advisor is always needed?
So let me just dwell a little bit on direct plans. I am not against direct plans. I have run an RIA with direct plans very successfully. So I am not against direct plans. I may go back to direct plans if the opportunity is right. But to invest in direct plans, you need to be able to choose correctly. You need to be able to analyze products correctly. And my sense is that for a very small investor who doesn't know to do this or doesn't have the bandwidth to do this or doesn't have the time to do this, just going and doing a superfluous choice on a platform or on a mutual fund research uh, portal is actually not adequate because his return expectation is high. See, every Indian investor has a high return expectation. Today, where is the money going in SIP? You tell me. The last 6 months or 1 year, where is the money going to SIP? Primarily, where is it going?
Mid and small caps.
Why?
Because of past performance, as you've been.
So,
Yeah.
what is the problem? Suppose it's negative 10%. Will they give the same funds money? So this excess confidence comes from past performance. And past performance comes because of the excess confidence. Because everybody is putting money, it's not falling.
So you're saying if investors can get it behaviorally right, then they can as well do it themselves.
Yes. In my view, the direct option was created for people who have very large sums of money, for whom materially it will be a very big sum.
Okay.
Materially, it will become a very big sum. The fees they pay. But somebody who has a small sum of money which has to grow into a large sum of money, materially it is not a very big sum. I'll tell you why. You you make a mistake in a choice of a fund, and you lose. Let's say you put 10% of that fund, and you lose 25%. It's 2.5% on your whole portfolio.
Yeah.
It's less than the TER of your whole portfolio actually. So the cost of a mistake is very high. Nobody does it. We are all computing the difference between direct and distribution, which I understand. There is a difference. But if somebody can add value to ensure that the difference is more than compensated, then you will have to make an objective assessment of that. And not again go back to this blind argument that I want direct. So I've seen a lot of people who are big proponents of this. When I see the investment and the return and what products they chose, what they did, I feel that they have missed the woods for the trees. That's the first point.
Okay.
And see, traditionally the Indian investor wants to get higher return. He also doesn't want to pay any fees or cost. In the process, if he makes a judgmental error in products by chasing past performance, evidence suggests that he's paying much higher than whatever he saves.
Okay.
Much higher.
Okay.
So I think the investor has to make a balanced judgment of this.
Okay.
I'm not going to say this or that, but you decide. If you're making mistakes and you're not able to avoid those mistakes, go to somebody who will help you avoid those mistakes.
Understand.
If he has got the skill.
Okay.
This is how I look at it.
Okay.
As a person who has done professional work as a distributor, RIA, portfolio manager, also as an investor, for me, the primary objective is avoiding mistakes. Because I've always felt that an investment mistake costs far more than any fee.
Okay. Understand.
Okay. And an investment mistake done at scale can be very, very fatal for the portfolio. So this is what I think a investor should, think through.
Okay.
And just going to a place where there is no assistance, where there's only no friction in transaction. See, today where are people going? They are going where there is no friction for transaction. Transaction friction and elimination of that friction used to be a USP 5 years ago in pre-COVID. Today, there is no transaction friction anywhere. So you need more than that for your investment to succeed. Just reducing friction is not a decision maker as to where you should invest.
Okay.
That era is over. Today you need something that will add value to you to make your investment successful.
Okay.
That's what I think investors should think about. I think when you look at what is happening in today's SIP, you have one set of people who are coming in, equal number of people are going out every month. Isn't the data saying that? AMFI data.
Yeah.
So that means that the reduction of transaction friction is not leading to better investing.
Okay.
Clearly, in SIP, because we're talking about SIP, I'm putting the data point forward.
Yeah. Shyam, the other thing from my own experience, when it was paper-based investing, you had control over how many funds you were investing in, how many SIPs you were doing and all, because most of the things were manual and you had to take effort to maintain records. Now, from my own experience, after it's become app-based and screen-based and all that, you can effortlessly add more and more funds to your portfolio. It's always visible. You can always see. And I myself have done it. But, at what point, would you call something as an ideal number of SIPs to have? Does it depend on the amount invested every month? And at what point does this kind of over addition or addition not lead to better outcomes?
I generally like to keep the number of SIPs below 5.
Okay.
And under rarest circumstances, I may add 1
Okay.
or 2. But number of funds, I like to keep it below 5, generally, the equity funds. Maybe if you are also having a liquid fund in which you're adding and then moving to equity, then that fund will eventually stop. It's not a continuous thing. So I like to keep my number of SIPs down. What you mentioned is very interesting. That is because of technology, the tendency to keep adding more funds is there. This is like the investment equivalent of quick commerce. Because somebody will come and give it to you at your door and you can just make an order through your phone by a click. You're actually buying a lot of things which you don't need. A lot of things are, avoidable decisions. Also, I think the noise that this digital era is putting in front of the investor is tempting. It's like if you're outside a stadium and you're hearing a massive roar, you are curious whether it was a 4 or a 6 or a wicket. You want to immediately go there and be a part of the action.
Yeah.
That's exactly what is happening in the digital era. So there's so much noise, and then cult forms for products, managers, and then everybody wants to be a part of it. So if you're not owning, let me add 1,000 rupees there. I don't want to be missing
Yeah.
out on that.
I've done a lot of
Yeah,
that
so
actually. Yeah.
I won't do any of that.
Yeah.
So as an investor, I won't do it. As a professional, certainly not.
Yeah.
So that rigor you should have. That's how you can make your investment succeed. So, but this all happening, and I don't think it will lead to a good investment experience. I'm sorry to be quite plain about it. Uh, chasing fads in SIP never ends well.
Okay.
And then we blame SIP, which I would blame the media and all these
Yeah.
fund journalists. They then blame the SIP, they blame the manager, they blame the fund house. I feel a more honest approach will lay the blame at the door of the investor
Okay.
or anyone who is inducing the investor. It could be anybody. Let's not say immediately it's a distributor. Platforms are doing the same thing because they have a front window which shows certain products. Now, have you made them accountable for how they put these products on the front window? Display. What shows up first before the investor?
Yeah.
So these are all the factors that lead to that impulse.
Correct.
So eventually the impulse is bad. Now who does it is irrelevant. And I think that ease of transaction is making people more impulsive. And that leads to potentially more mistakes.
Understand.
As an investor, I would like to avoid all this.
Okay. Staying with diversification, there's another side to this. Even the 4 or 5 zips you suggested, now there are a lot of portfolio overlap tools, tools for checking portfolio overlaps available. Even the 4 or 5 funds, if you feed it in, a lot of overlap in portfolios tends to throw up, especially because the universe in which the
Same 500,
funds
700.
invest is, yeah. Now, so what are you supposed to do about diversification? Now even the 4 or 5 funds may look like you're investing in the same thing.
Yeah, and then people will say, don't do any of this, go to indexing. I mean, how much do you want to dumb down investing? That's the question. I believe this comes from US, this whole thought process. I think Indians are definitely smarter than investors in the US. They can do better. And we are also a younger stock market, a younger economy. Headroom for growth is very high. So it is possible for a portfolio to actually be differentiated and to have positioning which is giving more safety and better growth later. I'll give you a very interesting example. Assume that fund managers actually invested away from IT until this fall and then went in after the fall. The kind of alpha they can generate is extraordinary. And applies to advisors also. If you avoided all this while and then you buy now. Now, obviously, in that fund, the overlap would not have been there,
Yeah.
whereas everyone else would have had. Now, this fund won't show up in the top performing fund when you look at it. So, I feel all these tools are not doing a job that will help improve the decisions. They are only further confusing the investors.
Okay.
Because it's very formulaic, no? Set pattern you're trying to evaluate a fund. But suppose there is a war and you want to invest away from businesses which are affected by that war. And you want to buy domestic businesses. And you want to buy business where consumption will be good, stuff will be there. Then how will these pattern readers adapt to that? I don't think they're adapting at all.
Okay.
It's one size fit all, 365 days, same
Understand.
approach.
Yeah.
So you are not bringing in the variables. Like for me, this war meant that I should look at businesses which are facing the domestic economy. Like I liked banking, I liked FMCG first, then I liked resource generating funds also. Now, when IT came to the bottom and there's so much pessimism, we saw Accenture hitting some $120 stock price. I felt that Indian IT probably was near the bottom, right? Now, I want the fund manager to have more weightage in this for the next 2 years. I didn't want the fund manager to have more weightage to this for the last 2 years. I'm making a clean shift,
Yeah.
right, as a advisor. Now, any of these overlap readers won't be able to do this.
Capture
I
it,
can
yeah.
give it to you in writing
Yeah.
because it's all written to give decisions which will lead to actions mechanically.
Okay.
Where is the thought? So you need a lot more thought in fund investing.
Okay.
This is the point I'm trying to make repeatedly.
Okay.
It should be very thoughtful. It can't be mechanical and brilliant. See, what are we thinking?
Understand.
You're looking at the past performance, take a mechanical decision to invest in a fund, and 1 year later you want it to be brilliant. I mean, the probability of your being right is definitely below 0.5. It's somewhere 0.2, 0.3.
Okay. Understand.
You must have caught it just on the way up. Only then you will be right. After it
Peaks. Yeah.
is when most people catch it.
Yeah.
So they go wrong.
Yeah.
Now, it's not SIP which is the problem. It's the way we do it.
Okay. The other thing about SIPs, which we always say, is when the markets fall, you keep continuing your SIPs and add lump sums if possible. So now there is a question or a doubt which comes to every SIP investor. Now, do I add lump sums in the same SIPs that I am doing? And if you do find that other parts of the market are attractive in which you're not actually doing SIPs, then are you going to be losing out by putting only lump sums in the other parts of the market? So how does this whole thing work?
Very interesting question. I like to put my lump sum money on merit.
Okay.
So, for example, with people in our distribution ecosystem, every week I give a lump sum call. Every week,
Okay.
which they can consider, and if they feel convinced, they can invest. It's a recommendation. So, every week I do it on the merit of the decision.
Okay.
Some days it could be, some weeks it could be where the SIP is going. But many times it could be elsewhere.
Okay.
But it will be within a fund universe for that investor.
Okay.
So inside the universe, you keep investing lump sums and strengthen the whole portfolio which you are building for yourself. And we suggest based on where the opportunity looks best. The lump sum should always go to the right place, not to the place where you already invested, and which probably may not be the right place.
True. Yeah. So if you've made a mistake in SIP investing, don't add to the mistake by adding
Oh, I
lump
won't do
sums
that.
there.
Certainly not. And nobody should do that.
Yeah.
But that's what is happening. See, now I always do the math. Now, if I bought the wrong fund and I lost 10%, what is the use of saving 1% in distribution direct? There's no merit. That argument itself doesn't apply. If you buy the right fund indirect, you're home. If you bought the right fund through an intermediary or an advisor or distributor, you're still home.
Yeah.
There's no problem with that. But you have to get their fund right, fund choice right, right?
Okay.
And the cost of mistake is more than whatever is the money you pay to people to get it right. Whether it is platform, whether it is a distributor, whatever, I mean, or RIA, whatever it is. I think that the decision cost is cheaper than cost of mistake.
Okay.
That I'm very clear.
So another angle to SIP investing, usually it is applicable to equity funds. And we see very rarely investors do, but some of the investors do SIPs in debt funds also. Do you think SIP as a strategy will work for a fund category which is not very volatile? Essentially, SIP is meant for averaging, isn't it? The other thing is also about the market conditions. So if the market is going up or coming down, one way or the other, SIPs tend to help. But like in the last 2 years, if you see a sideways market,
Not
it's
help.
not, it doesn't help at all.
That's why
So,
people are very upset.
so SIP doesn't work at all times and for all categories, isn't it? So people should be
No, it will work
wary.
at all times provided you choose the categories correctly. For example, peak interest rate.
Mm,
Interest rate is at its peak or just going to peak out. If you do a SIP for, let's say, 1 year or 2 years in debt, in the right products, you will make very good returns. You
okay.
can raise your overall return by 100 to 200 basis points over what that fund normally makes. And similarly, when it comes down, you add some lump sums also further. So you can. There's a time to do SIP in a debt product. Usually from peak of a rate cycle towards the bottom. And when you're very close to the bottom, you flip it again.
Okay.
That's something you can do. Similarly, you can do SIPs in precious metals when the market is flat, not peak to bottom.
Okay.
After it's come down and it's listless, in that phase, 2-3 year phase, you will get. Na? In that phase, you can build your precious metal position. In equity, when you start in a theme which is out of favor, I think you'll actually do better. Provided the manager is top class, the product is constructed well, and the manufacturer, the AMC, will allow this product and manager to just do their job for 3-4 years. Because if they keep on asking, why are you not making performance, then suddenly you will find a manager investing in Reliance in a tech fund, saying that they are in telecom. That kind of investing will happen.
Yeah.
Right? So you have to be careful. You have to see all these three things, then you're good. So you should buy when they're out of favor and hold it till they're in complete
Okay.
consensus.
We spoke about this in the previous episode on thematic investing. I think that you could do SIPs in thematic funds when you have a long runway.
Even large cap has to be done in a very nuanced way. Suppose a large cap fund manager is making all his return only in that small cap or mid cap which is allowed to buy, non-large cap. Then I think you have to be careful, no? When he stops making money in that, he will not perform.
Okay. So net, you're saying that SIPs can be done in all categories provided you do it at the right time and in the right way.
Yes, your product selection has to be very nuanced. That's what I would say.
Yeah.
I think you should understand a portfolio and do a SIP, not look at the past performance and do this.
Okay.
So anybody who can do this on their own is free to do it on their own. There's no problem with that.
So we did speak about taking the services of an advisor vis-a-vis direct plan, and essentially it came down to the behavioral aspect, controlling the behavioral aspect. Now, to get better returns, assuming you get your funds right, you still may not be able to get better returns because of your entry, exit, and other reasons.
Scaling up also.
Yeah,
How do
and
you put
scaling
more
up
money
also.
in?
So, do you think you still need an advisor to get better returns?
See, it depends upon how you view performance enhancement in your life. The best sports persons who actually succeed because of their own talent have coaches for their mind. They travel with teams today, your cricket teams, they have people like that. The best investors also have somebody like that. Warren Buffett had a Charlie Munger. I am sure a lot of investors have these kind of people. So every investor can have a person like that.
Okay.
It could be a friend. If you don't find that friend, let's say you are living in a place where you don't meet such people, then get an advisor who will be that person. But having such a person in your life who makes you bring out the best performance in your investing is actually not a bad thing. It applies to all walks of life. And many of us consciously go every now and then to people who may not be as successful as us also in investing, but to get their inputs on what we are thinking. What does that mean? It means that you need input, right? You need external input.
Yeah.
So I think input is needed, and that input should be a very high quality, and it should make you bring out the best from within yourself in your portfolio. So how you find that is
it could be a friend, it could be an advisor.
that's the
it
point
could
I
be a
keep saying. But
distributor.
you can't find. So
Yeah.
I have thousands of investment friends, but I can talk to only 2 or 3. There are people who can talk to only one person. So you have to have that person in your life, and that doesn't come cheap. I'm just telling you, it's a lifetime investment in a relationship, right? How many professionals today have time to invest in such a relationship with such a person? He will say, "Come at this time only, then I'll talk to you." It's like a guru, literally.
Mentor. Yeah,
Yeah.
yeah,
So, or a mind coach.
yeah.
So, behavior improvement is something which will need external influence. That's
Okay,
I'm very
okay,
sure about that.
okay, okay. So the other interesting aspect about SIPs, which you did touch upon earlier, number of SIP accounts opened is almost equivalent to number of SIP accounts closed.
That's very sad.
So even our own internal data, if you see, SIP stoppages predominantly the reasons seem sometimes predictable, sometimes frivolous. So predictable reasons will say medical emergencies. Frivolous reasons will probably say, I want to change my bank account or I want to change other operational aspects. Some people will say, no, I just want to
Change
uh,
from my name to my
to
wife's name.
somebody else's name. And sometimes actually people leave bank accounts empty. So consequently, 3 months later,
That
SIPs
is happening.
automatically stop. See, these kind of things keep happening. Now, how do you talk to an investor who does this? Because these are not people predominantly who don't realize that SIPs are important. Continuing SIPs is important for long term goals, but at the same time, when execution comes, they fall short. So,
It's a very sensitive conversation.
mm,
I personally want every investor to invest regularly. That's the reason. I've been 36 years in this market, 200 trading days in a year. Yeah, almost every day I would have done something. Almost. Rarely does a day go without me doing something. So always there's something little to do. So for the retail investor who is coming to the market, it may not be like me because I am investing for others. There's something to do, but there will always be something to do every month at least, no, and then a few times more. So once a month doing it and then doing it a few times more is something which is nothing but an extension of what I feel has worked for me in my investing life. So I think you should continuously do something, and without that, you are not going to do enough. Now, what happens when you break this? Like you mentioned, we have these stoppages. We have a set of people who talk to people who have stopped after the first, miss. That is, your installment comes to hit the bank. You don't have enough money. We have somebody talking to that person and telling this happened, should not happen. Next time, please keep the money. If you want to invest this money, let's say you'll say it's in another bank account. I didn't notice something like that. So you'll say, would you want to make that investment? Can I initiate it? Would you want to still continue that? The reason is we don't want the habit to be broken. Look at it from a professional point of view. Going and talking to a person who is not actually maintained the required discipline and then making him bring back his discipline to the required level. Suppose his conviction has gone down, making him improve his conviction by giving him all the things that he needs to know, working on his behavior to bring it back to
yeah,
top standard.
yeah,
All this is a lot of effort. If you just leave that person out and then go to a new person who's got the right behavior, you will get the same business interest fulfillment. But we still do it because the person who's not able to do this correctly needs it more than anybody else. I find people are very fickle in the way they are dealing with the SIPs. But fortunately, in the people I interact with, it's a smaller number. But if you look at industry wide data, it's a very large number.
yeah. Coming to the industry-wide data, we do see that retail investors, about 55 to 60% of the people continue after 2 years. That's Amphi data. So it's also it's not a one entity problem, it's an industry
Correct.
wide issue. Now, when you look at this number of 55 to 60%, you do know that these investors continue. That's only the 40 or the 45% who don't continue. So, at the same time, when markets have been flat in the last 2 years, it is the SIP money that has been sustaining despite FII outflows. Now, how do you see this situation? It's like, two ends, isn't it? So, do you look at it as a glass being half full or a glass being half empty?
It's actually both. Unfortunately, you can't pick one. See, the fact that there is so much of domestic discipline and so much of predictable domestic capital to support the market is a huge positive. But where I feel bad is that this capital is only chasing more risk
Okay.
because it wants more return. And in the process, it is setting up a new risk. Whereas if the domestic capital was more responsible in the way it is chasing opportunity when, let's say, FIs are selling or others are selling, then I feel this investment experience that the mutual fund industry can give to domestic capital in the longer term will be better. So you will not have this 2 year drop off rate, or people, you will not have the 1 year drop off rate, which is actually unspoken today. See, if a data point is taken today, how many people have stopped a SIP within 1 year? It will be very interesting. And if you see how many people have stopped it on their own, after starting it on their own, both should have been done by the same person. You started on your own, you made the fund choice, the decision to invest, and the actual investment, SIP. And within 1 year, you stop it. Both decisions made by the same person. Then you will realize what kind of behavior we are manufacturing. You should not look at the data and say, oh, 32,000 book size, all is well. That all is well is not a good statement. What is happening to the actual investor? That's very important. We are not looking at it. And I feel the investors are going through all kinds of things, psychologically, financially, then fear-wise. They're going through fear. And the way they are approaching greed should not be the way it's being done. So all these things we are not seeing as a society because our headline number is
Looking good.
looking great. And that's why you see this data, 2 year is bad. Because we are not connecting the headline number to the actual ground. The moment we connect this headline number to the ground, then we'll see the investor more clearly and address what needs to be addressed for the investor.
Okay.
That remains to be done. And I think that's a huge responsibility for the asset management business. Only the AMC business has to do it.
Okay.
Along with its ecosystem of, let's say, RIAs, distributors, whoever.
Okay. Whether you do it yourself or seek advice, getting your behavior right is what matters most for successful SIP investing, is the key takeaway from this conversation. Thank you for watching and see you in the next episode of Decode.